After an extremely volatile October, the bulls are smiling and will continue to do so after the midterm elections, because that's just how history shows it. But that's actually according to our next guest, who says tonight's likely result, a split decision, is the best possible scenario for the market. So how is he recommending to invest? Ryan Detrick is the senior market strategist for LPL Financial. With those ideas, what's your thesis, the bulls smile after the midterms?
Well, Liz, first off, thanks for having me back. But you're right. We just had a rough October. And then you look at history, usually you have strength after that. Let's look at the last two elections real quick. 2014, big correction into the middle of October, and then a rally. Obviously, a 9-day losing streak ahead of the presidential election back in 2016. Now we've had that big worst October in a long time, worst month in a long time. Look at history, Liz. This is the fourth quarter of a midterm year. Sure enough, that's actually the strongest quarter out of the 4-year presidential cycle. Now, I know it started off down 8% after October, but the good news is November and December historically are pretty strong. Once you get that election out of the way, you can focus on those positive fundamentals, which we still see. We still think I wouldn't even call it a surprise. We still think a good rally to end this year is quite likely.
Okay, it's likely. Then what do you like in that potential climate?
Well, first off, Liz, great question. We still like stocks over bonds, but then you get under the surface. Value's had a rough ride, but look at what's happened in October all of a sudden. Value stocks have started to outperform growth stocks. We still don't have a problem with growth stocks. They've just done so well relative to value. Also, don't forget, value does a little bit better when the economy does better, so we like that group. The other one we like is a little more aggressive, emerging markets. Emerging markets just had a 20% correction recently. You know what, though, Liz? Emerging markets have more earnings growth expected next year than U.S. stocks do, than the S&P 500 does. Also, valuations are a little bit lower in emerging markets. So if you don't think we're going to have this crashing global recession, which we do not, we think emerging markets is a place for the rest of this year and next year could provide some alpha and some outperformance for well-diversified portfolios. And
let's end it, because right now we're at session highs, Ryan, and it does take a little bit of a stronger stomach to go into emerging markets, but people seem to be diving headfirst into trading today. It's good to see you, Ryan.